just before the video starts, just don't watch this if you don't already know DTFX and the shit show model, etc., etc. This is just my perspective, me trying to work out some of the contradictions in my mind as well as give myself a refresher as to how market structure works because I haven't reviewed these notes in a little minute. So yeah, if you already understand all of these things fully, then go ahead, watch this video, but there will be links to all of the resources in the description. So yeah. Alright. The point of this video, I'm going to be doing active narration of all the notes that I've taken of the original masterclass, just as a refresher for myself. And I'm just going to be putting it out there because these are succinct notes, right? Like the masterclass itself is, I believe, 24 hours around there, 24, 27 hours worth of videos. And it could be kind of difficult to go through all of that information. So I'm going to be including all the notes that I've taken, in-depth notes, and all of their timestamps for myself and for onlookers to go back to and review. So we could get started. 012. Dave is currently showing us how when we tap into a POI coming from the left, we want to buy low and sell high. As price is pushing up, most people want to take their profit as their position is increasing, close their order, and they've made money. Some people close their order and want to get in again. 059. However, getting in again to go up would require you knowing where price is going to stop and turn around. 1 minute and 30 seconds. Along this entire push-up, there were certain areas left behind because obviously most of the time the market doesn't look like this when it's moving up. He's referring to a graph that he made. And I guess I'll pause to show what I drew. So then, along this entire push-up, right here, there were areas that were left behind. 2 minutes and 50 seconds. This huge move up was that for a couple of hours it just kept moving. So consider this like the 4-hour or the hourly time frame. 3 minutes and 40 seconds. However, if you go down to the 1 minute, you're going to see the move up possibly in the form of a couple of candles. So imagine if from the 1 hour, these are the candles that you see on the 1 hour, and this is the overall higher time frame candle. The concept I just explained, the timestamp was 5 minutes and 11 seconds of video 1. 6 minutes and 20 seconds. And on the hourly time frame, the highs and lows would be larger. But during this time that it's going up, it's pulling back. These are what the highs and lows would look like from the hourly time frame. 650. We want to get in at an area where price will continue or where price will continue to go down if you're capable of shorting the asset. 7 minutes and 30 seconds. Some people short as price goes up, and that's how they're losing. We're placing a bet that price will go down based on what I see on the charts. And this decision in an uptrend, you can enter a short position anywhere that you see the market retracing. And you can enter a long position anywhere you see it going up from. 9 minutes and 40 seconds. As you can see, price looks different across these different time frames. 9 minutes and 40 seconds. As you can see, price looks different across these different time frames. 10 minutes and 40 seconds. The 1 minute typically will be a series of highs and lows compared to the hourly, but on the 15 minute it'll be the one high and low that comprises of the series of the 1 minute highs and lows. 11 minutes and 20 seconds. So what we see it's pointing to is the fact that on the 1 minute there are more pullbacks to time and hope to be right, or more opportunities you can be wrong. 11 minutes 58 seconds. Typically, if you're trying to make money for the day, you have about 3 to 4 opportunities on the 1 minute within the 1 to 2 hours that you're trading to be right or wrong. To be right or wrong on a pullback slash reversal, hourly top slash reversal. 13 minutes and 50 seconds. With these highs and lows, you can place a buy there when price comes back to the area you're looking to trade from, and you can TP as price increases. 14 minutes and 50 seconds. Oftentimes on the hourly, it looks like a candle that oftentimes is going up and down. This happens because on the 1 minute time frame, we can go up and down a number of times. So while our 1 hour candle has been formed, we have the candle moving in this formation for that whole hour, and it can close any way it wants. He then goes on to show an example as to a doji or an institutional candle. 17 minutes and 15 seconds. When dojis occur, it's because on the lower time frame when the candle opened up, we were here. Then we began to retrace a couple times later. During the hour on the lower time frame, we began moving back up, then it went down. I'll draw an example of this. So this is an example of the hourly candles going up and down and being representations of what I was explaining earlier on in the 1450 timestamp as to how the 1 minute is causing these changes in the candles to look like this, and that they're represented on the lower time frames from the 1 minute as highs and lows as opposed to individual candles. And this is a representation of the doji and how it looks like from the 1 minute, with this high and this low and this high and this low, and how it could look like from the higher time frames. It's essentially a reversal pattern, but we'll go into that later. At 20 minutes into video 1, Dave defines what the trend is. If the market is going up, there's a bunch of highs and lows that are created as it's going up. That's trending up. If it's going down, it's vice versa. 21 minutes and 15 seconds. The downtrend looks exactly like the uptrend. We make a high, a low, a continued series of more of these highs and lows. And as you pray you didn't buy at the top, as your position becomes more worthless with each pullback, holding it in hopes to go break even. And then I'll draw what the 5 minute looks as you see the 1 hour launching back. So he was basically saying, imagine this was the top you buy at on the 5 minute. As you pray that price doesn't come back to your entry, or price does come back to your entry, the lower and lower and lower that it goes. And then this would be the representation of the 1 hour launching back to your entry. 23 minutes and 11 seconds. This is because as the market is going down, they don't understand that you should be short now that the market is going down. Until where though? The hourly place that price is looking to grab to continue up. As a side note, it's important to know that these areas you're only going to know in reference to what you've back tested. 24 minutes and 20 seconds. This is representative of an hourly trend, and it will sometimes go up for hours, days, even weeks. So if you're trading the hourly, you might want to wait until Tuesday to get into a position that might bring you to your profit on Thursday or Friday. So let's say you're here, This is Tuesday. Then this would bring you to your profit on Thursday or Friday. 25 minutes. But if you're trading the 15 minute, you might get in a position at 10:30 to hold that position until 12 o'clock. 25 minutes and 15 seconds. So as the hourly trend was going up, you took a position and got out of the move and profit along this 1 hour hourly trend up. And you were guided by where you saw the hourly move turning around. 26 minutes. So when the market is going up, it's because there's a demand for a particular stop and for the market as a whole. 26 minutes and 10 seconds. And you can see where this demand is located on the charts. 26 minutes and 20 seconds. Oftentimes, the demand is located at a particular point the market reversed. Some previous areas as to price was going up, that price actually tapped into. So as price goes up, taps into this area. As price is coming down, taps into. The demand area, 28 minutes and 50 seconds. The demand area from below is where price originally came from. The move origin. This is representative of a move origin coming from the left. If it's coming from something below most of the time. There's also move origins on the top as a side note, but usually it's coming back into something to move higher. So 2 weeks ago, the market was down at these levels to the left. I'll draw this. So as the market approached these levels again, it began to move straight back up to an opposing area on the left side. 30 minutes and 8 seconds. So price comes back to the area where it sent that whole move up because there's a bunch of people waiting who missed the move the first time. These people are still willing to buy at this price. 30 minutes and 31 seconds. But simultaneously on the way back down, we are also downtrending. So as it's going down, you can get into a short position and say, based off of what I've analyzed or based on where we previously pulled back from, we could get into a position. This is essentially how he outlines it. You basically get into short positions as you know you have targets underneath to these move origins. Or I'm sorry, based off of the demands pullback from a certain area to the left. So this is one that I drew up here, representation of a demand, but there's multiple demands along this hourly trend that price is pulling back into from. 31 minutes and 32 seconds. In a healthy market, keyword healthy, price will continue going up after it pulls back. 31 minutes and 40 seconds. Or it will continue going down. So if you know where it will continue to go down, you can enter a short position while it's going down to make some bread. And every area where you think it's retracing to continue down, you can add another position going down. 33 minutes and 10 seconds. But how do we know that the market isn't going to continue down? The area it came from is the deciding factor, the move origin. You want to look for buys if it's underneath and you're approaching. Above will be another move origin, where you may want to take your profit or begin shorting to go down. 34 minutes and 11 seconds. But you'll only know these areas to short from as the market begins its down cycle. So to explain the previous thing, imagine you have an origin like this to the left, right? And you're approaching it. He's saying that you should be looking for buys if you're approaching it, or hold on, let me just do this. Or even if we come underneath it, because then the market is primed for a huge pullback. We'll go into that in the future notes of this video, of video 1. But as you're approaching this and you're looking for buys, you may want to target the hourly origin above, which would be something like this, or maybe even an origin to the left, something like this. I'd say target this origin because you don't want to try and be right about a high. So this would be more in confluence with what he teaches. 34 minutes and 20 seconds. The problem is within these multiple entries to go up and down, you have multiple highs and lows, lots of areas as you get into to go short or get in to go long. 35 minutes and 55 seconds. Given these multiple opportunities, this doesn't mean you get in a position to hold to some extraordinary high, but this is not the way the market moves. So in this area highlighted, most people are trying to take price up, but this area is not the area that's designed to take price higher. This is the area. 37 minutes and 30 seconds. So in a downtrend, you're buying to take it to an area you're willing to short from. 37 minutes and 47 seconds. So if you're getting involved on the 1 minute, know the area you're looking to TP is going to be an area you're looking to short from in a downtrend. So notice how here we tap into the low in this downtrend of this S&D zone to the left, and we immediately go back up and tap into the bottom of this S&D zone. This would be an appropriate target and an appropriate way to continue the downtrend, tapping into some sort of first imbalance to the left side here. If you notice what I drew, first imbalance to the left. 38 minutes. And because the market is going down, you're going to get a lot more shorts than from longs, or a lot more from shorts than from longs. Even as the market goes down, there will be quick opportunities to go up with. 39 minutes. You need to know where you're going to get involved in that trade going up and where you're going to get involved in that trade going down, and for how long. 39 minutes and 30 seconds. So not only do you need to know where you're getting involved going down, but where you're going as well. Because just because it's going down for the day doesn't mean that somewhere during the day it can't have a huge push up and begin to now trend up. 40 minutes and 30 seconds. And when it begins to trend up, all you're looking for is for areas to get in on a buy or sell depending on the time frame you're on. You'll have multiple opportunities to buy and multiple opportunities to sell. 41 minutes. So the higher time frame you're on, the less opportunities you'll find a position to buy in or find a position to sell in. 41 minutes and 50 seconds. So these areas are highs and lows where you can get in for a sell or a buy. So then again, imagine this blue line is just the hourly trend. For 1 hour of the day, we're going straight up, right? And then for the next hour of that day, we're going straight down. Straight up again. The hourly trend can change throughout whichever part of the day. But you have to know the area that it's coming from and the confirmations within these areas to understand when the trend is going to change. 43 minutes and 10 seconds. So if you draw it on your chart when we are going up in a higher time frame trend, there will be multiple highs and lows if you're looking at the lower time frame. 43 minutes and 40 seconds. Price will take this move up, and it can be a couple of hours that it's doing this. And now that it's going down for a couple of hours as well. 44 minutes and 25 seconds. Just within this hour as it's going up, there are multiple people buying and selling, but there's more buying going on than there is selling. Going down, it's vice versa. 45 minutes and 10 seconds. They have multiple opportunities to buy, get in, and get out. but they are limited because according to the parent structure, the structure that has the authority more than the lower time frame structure, according to the higher time frame structure, we are going up. So more money follows that until we hit our supply. 46 minutes. So when the market started to go up, Dave said it was going up from a place of demand. Dave told us where this demand was. The demand is located at the beginning of the whole trend, the move origin. 46 minutes and 58 seconds. On a higher time frame in our current market, you might see one demand area below and one supply area above. But on a lower time frame, you see a bunch of supply areas above and a bunch of demand areas below. 47 minutes and 13 seconds. What are those supply and demand areas on the lower time frame? 47 minutes and 30 seconds. They are the lows and the highs. The lows and the highs. 47 minutes and 50 seconds. But when we are going up, the supply is a previous high that when they touch, it'll begin going down. 48 minutes and 50 seconds. After it touches, it begins to go down. 50 minutes and 40 seconds. Or actually, I'll start at 50 minutes. 1. You'll have price go down after touching there, and it'll tap into some area below. The price is demand. Oh my god, hold up. 49 minutes. So this current trend that's heading up to take us there, we're going to a supply, a previous area, or a previous high point, and that the former trend that the price was coming down in will have to go back to those highs. And at those highs, there are different things that take place. So just imagine that this white line is the current trend that's going to take us to this high. 50 minutes. You'll have price go down after touching there, and it'll tap into some area below. The price is demand, being that this green area is the price's demand area below. 50 minutes and 40 seconds. Dave mentioned earlier there being a series of highs and lows on this hourly trend. And with this series of highs and lows, there are lows on the lower time frame that are little retracements on the lower time frame. That price will touch and continue up again if it's meant to continue up. So this green area would be representative of a little retracement on the lower time frame that if price is meant to continue up from, it'll continue going up from. So this old high is where you want to begin to sell the market from. 52 minutes and 10 seconds. And this short position is oftentimes headed towards the demand, so it can tap there and people who are buying, they will buy from the demand and price will continue. 52 minutes and 40 seconds. Now, it doesn't always continue higher from the area the demand began falling from, the area it tapped into the supply. 52 minutes and 50 seconds. The area that it tapped into the supply, it made a high, and then it lowered price. So the question, 53 minutes. Some might ask, why did we continue going higher if you said the previous high is a supply? The answer, 53 minutes and 20 seconds. In a trend moving up, price can give you a little movement away from the previous supply, but then it can continue. As a side note, this comes down then to one principle. Because ultimately, what he's saying here is that we don't actually understand or know definitively where price is going to continue the trend from, right? The area that it comes from is the deciding factor, but those areas can be invalidated at any time that the market chooses to do so. So it's up to you and your ability to follow price and look and observe the confirmations within each of these areas to understand and know where price is planning to move from and to. And I'm only saying this because at the 53-minute and 20 timestamp, when he gives the answer and a trend moving up, price can give you a little movement away from the previous supply, but then it can continue. This means that if you are going based off of the previous price action, that price is bound to move down, and this continues moving up, then you were wrong. The trend is actually an uptrend. But you'd only go and know based off of your understanding if you were not following price and forcing an idea of price. If price was moving down, you'd only know that it was moving up if you disregarded that entirely and chose to follow price within its confirmations inside of these areas. 53 minutes and 30 seconds. So you get into a sell position here and it went down just a little bit before invalidating you, before coming back to your stop loss. You must be willing to get out at your invalidation if you were wrong about the position. 54 minutes and 40 seconds. So the supply helps you to determine if your trade goes in the opposite direction and you are losing money. The end of this supply at the top of this old high is where you are getting out. It's where you say I was wrong and about price going down. And this is where I'm willing to maintain my stance on price going down until I reverse my bias. 55 minutes and 45 seconds. Now, just because you're forced to change your bias once price invalidates you doesn't mean you automatically jump into another trade and try to go up with it. Now, this brings me to another point, another side note, where Dave just said that we want to take areas off of previous supplies, right? This is technically a previous supply. But, like I said, if you're not observing the different types of confirmations and what they mean in regards to the time frame that they're coming from, this is a nuanced point, then you're going to get smoked. So here we have proper confirmation that price is moving up, right? It takes a former high. But here, price may give you confirmation on a lower time frame that it wants to move out of the direction, give 1-to-1 on the high that it's coming from. But it didn't take the higher time frame low to continue going down. So here it's indicative that, okay, price doesn't want to actually move in the direction that it's coming from. And from here, if you're taking a more aggressive entry from a seconds time frame, you'd want to shift to break even a lot quicker because it's unsure of whether or not it's actually going to take this low here. So that's just a minor nuanced point. So again, you're not looking to take a trade as soon as price invalidates you at this supply if it doesn't validate you. Because again, if price is just looking to tap into something above, let's say like the 50% of this one, then you're going to get completely smoked. Completely smoked. And you'll see this, right? Where it'll tap into something just barely above after invalidating you here. Maybe you captured some points, but as soon as you get in for a long, let's say targeting this high, price immediately comes back down to your entry and takes you out. And the formation of this supply area here is not typically something that you want to try and take trades from. The one exception to the rule is if I told you here you see some sort of confirmation here on the seconds time frame, a candlestick structure flip, also known as. But again, there's nuance as well because the candlestick structure flip has multiple different patterns that it's capable of forming or in correspondence to the larger time frame. So this would be a smaller candlestick structure flip here. But if price did decide to take this low, then this would end up becoming a structural flip and allow us to take the move back down. And like I said here, this is likewise with the demand area as well, where price will tell you through the formation of candlestick structure and structural flips that it wants to go back in the other direction. 5750, this decision occurs either at a former low or at a former high. Apparent supply, this would be considered right here. 58 minutes. So the only times you're looking to get involved with a trade when you're going to buy or sell are only at areas of supply or areas of demand. Nowhere else. 59 minutes. If price is just going up and up on the time frame you're looking to place a trade on, you missed that move. That is not for you to get in. 1 hour and 2 minutes. You're only looking to buy once the market comes back to where it came from, or you're looking to sell the market from where it previously came from, typically from hourly areas. 1 minute or 1 hour and 5 minutes and 50 seconds. This may seem convoluted from the 1 minute, as there are way more lows than down moves, as every single low is a demand zone. 1 hour and 7 minutes and 30 seconds. These consecutive lows are exactly why you see price move in a series. 1 hour, 8 minutes, and 30 seconds. And a downtrend, buy temporarily. Price can sometimes go straight through these demand areas. The answer is yes. They can go straight through these demand areas sometimes. 1 hour, 15 minutes. On the 1 minute, out of all of these lows, you may be asking yourself which one will hold. That is where multi-time frame analysis comes in. And I skipped one. 1 hour and 9 minutes and 22 seconds. This is because the overall trend is currently in from the higher time frame is short until you get down to a particular area on the hourly that allows price to go long again. That's why they can go through demand areas sometimes. 1 hour, 14 seconds, and 30 minutes. When price gets to that 1 hour area, you're only looking for buys that the area that you're trading from is set to turn price around and take it higher. 1 hour and 13 minutes. So you need to ask yourself if you're here, and if you are, you need to look for a particular pattern with the candlesticks before you begin looking for buys. And on that point entirely, if you're corresponding that to an hourly area, let's say this is an hourly area, right? This low is the hourly area. If you're looking specifically for a candlestick structure flip in here, then you're going to get smoked because the hourly area has to accumulate for some time before it can get that formation, specifically the candlestick structure formation you're looking for from said hourly area. And what this looks like, if we go back to this over here, is that this is essentially just this. If it wants to copy, where is it? Why did it do it like that? This is essentially, oh shit, wow. Just this. the hourly institutional candle. Now, I wish I could resize it a bit more. Can I? Well, if I delete this and just grab this and make this just a bit smaller, that this is essentially just that hourly doji that you're looking to form from its respective time frame. So if you're looking for a candlestick structure flip out of this specific area, unless you have a specific narrative, let's say price was coming in extremely hot, right? Like very, very hot. And you're looking for some sort of V-shaped recovery to instantly take you back there, then maybe you can get away with a candlestick structure flip here. But it's a hyper aggressive entry in a very, very, very explosive downtrend. So along the way, if you're choosing the wrong demand area, let's say like I don't know, a smaller one like an S&D responsible from over here, and price smokes you here and ends up tapping lower into this area here, then that aggressive entry on the candlesticks within a V-shaped recovery is going to smoke you. But if you wait for that accumulation, you wait for the formation on the hourly time frame for the doji, then you can enter in on the lower time frames uh, with a confluence sort of or type of entry. As a quick side note, 1 hour and 16 minutes and 35 seconds. So your sole job as a trader is to look for these areas that price will continue up from or that price will continue to go down from. And depending on the time frame you're trading from, you can hold that move for a couple of minutes or a couple of points. 1 hour, 19 minutes, and 15 seconds. You may ask, if it's the beginning of the move price is moving back to, why is it that within the middle, price tapped into that middle and then continued to go higher? You might ask that. The middle being a supply area like this. It tapped into it, came back down, and then continued to go higher. And Dave's reasoning for that is because that's the way that the market moves. 1 hour and 20 minutes. Dave begins explaining basic supply and demand and how the entirety of the market moves using real life examples. 1 minute or 1 hour, 29 minutes, and 20 seconds. Dave speaks on different market conditions as price pushes itself higher, giving shallow or deep retracements. When we continue to push and the market doesn't pull back, it's an unstable market, similar to what I explained here. This being a giant push down and you anticipating some sort of V-shaped recovery here. It's an unstable market. 1 hour and 29 minutes and 45 seconds. Dave continues to explain that creating structure in the market, and that structure is creating stability for the market. That's the reason we pull back. 1 hour and 30 minutes. The market isn't perfect, so sometimes you'll see it push without ever pulling back. This just means that it's primed for a huge pullback into the previous demand. But first, what has to happen? 1 hour and 31 minutes and 20 seconds. You see us come above a supply and begin to pull back into the previous demand. Meanwhile, the next supply is even further up. Dave talks on the different possibilities that may occur on the hourly trend and how we can even break the move origin that sent us higher from our position instead of going to the supply above. And when this does happen, it's telling us that on a higher time frame, the market is now in a higher time frame bearish trend, even above the hourly. 1 hour, 32 minutes, and 5 seconds. So until it breaks below, we are still in a higher time frame bullish trend. So that doesn't mean, if we go back to this example over here, that once we come into this move origin, we have to just wick below. No, we need a strong body closure for us to know for sure that we're going to go in the opposing direction. One hour and 32 minutes and 30 seconds. We know the higher time frame is in a downtrend. When it goes below its former low, the low that put in the high, the former demand, when the market goes below the former area it came from, that's the first sign that the market is reversing and that it will continue to go down. So this area, this former area inside of here, when we go underneath this area in which the market came from, that's our first sign that the market is looking to go down. After we run below it, it provides a pullback up, 1 hour, 35 minutes, and 20 seconds. A pullback up into the area and then provides a short going down, 1 hour, 36 minutes, and 50 seconds. But just because we have lowered demands on the hourly doesn't mean that price has to go down there. 1 hour, 37 minutes, and 10 seconds. Usually when we run above the former higher time frame high and we're trending up, we run into the former demand zone below. We're expecting that that demand zone below that sent us up, the move origin, to put in a new high above where the previous high came from. One hour, 39 minutes, and 0 seconds. And when we reach that supply and there's no strong demand anymore at that supply, you will see price start to break down. No strong demand anymore, and to go back to a former low or area that price came from. That's what it means. So in my notes there, I wrote the move origin as us expecting to put in a new high. It doesn't necessarily have to be the move origin though. So like for example, when we retrace into this area after breaking this higher time frame high, this is one possibility that it trades and puts in a market structure break. But another possibility is that we bounce into here, either the 50 or maybe some sort of SNDR, and then we continue moving up. That's another possibility. It doesn't necessarily have to be a move origin that we're expecting price to go up from uh, after tapping into a a former supply after running a higher time frame high. So for example, it could look something like that. 1 hour and 40 minutes. Just change the color of this. If there's enough demand in this area after putting in that high, it'll put in a new high without ever reaching the unmitigated areas below. But that's only if there's enough demand here. You'll know if there's enough demand here if when you get here on the lower time frame, you have a series of highs and lows coming down, and price goes above an old high. so you can catch the retracement as price continues its uptrend. 1 hour and 45 minutes and 40 seconds. When Dave speaks of former areas of supplies and demands, the truth is, when he speaks of former highs and lows within these areas, it's because he wants us to choose these, because that's where the larger movement comes from within the smaller trends. 1 hour, 46 minutes, and 14 seconds. But there are times where price will not retrace back into that former low slash demand. It'll just tag the top of the old high and continue up. So for example, if we have a trend like this, sometimes price won't retrace back into this former area. It'll just tag the top and then put in a new high. Instead of tagging the low. And this is why the 50% works so well, because you're expecting that deep retracement, stops behind the area, and a movement back up. And before I move on to the next point, normally when we tap into an SNDR like that, it's after we break above this, proving that we want to move higher. Not like this. I believe Dave makes a key distinction, because if price had strong demand and was indicative of a stronger demand moving higher, then it wouldn't fail to put in a new high here. 1 hour, 48 minutes, and 50 seconds. So now these smaller moves on the 1 minute, the smaller down move slash down candle slash down areas before price continues higher, just know that these smaller areas don't hold nearly as much as the areas on the higher time frame. 1 hour, 51 minutes, and you should only be looking to get involved in buys when the market flips at previous demands, not after price taps it and it's running up. One hour, 52 minutes, and 50 seconds. Your stop will always be behind the zone you're trading from, looking to target potentially the new high. And I skipped a note. 1 hour, 47 minutes, and 3 seconds. Dave is constantly talking about the lows, but the truth is there are actual multiple demands even on the 1 and 5 minute trend. Because even on these lower time frames, there are also a series of highs and lows formed by the candlesticks. 1 hour, 53 minutes, and 30 seconds. If price is not going to run the high, what it's going to look like is price will stop at some former supply that's there, and it'll stop, violate one of the older lows. So it essentially just looks like an equal high. And I'll show you guys something real quick that just came to mind. In this video, Dave took a short here. This is his live futures trading NQ Rave live stream from this Friday, the 7th of March. He took this short with confirmation here, right? Shifted his entry to break even as soon as it broke below, and he stopped it. If you notice, price violated this low, he shifted to break even, and it didn't come back to his entry. And he said that as price was coming back down, he was just trailing. And here he was indecisive about whether or not to trail all the way, because once you take a low like this to the left, if you see price, oh my god, if you see price break above this high with a body closure, his targets were down here at the bottom of this SNDR responsible, then it's possible that it could come back and take your entry and come back all the way back up here. It's a possibility, but this is where it would start. So here, like I said, at 1 hour 53 minutes and 30 seconds, if price is not going to run this high to the left, what's going to look like is it will stop at some former supply that's there, and it will violate one of the older lows. And here I also marked out that it would also stop at a demand here, some former demand, and then violate one of the former lows. You had a candlestick structure flip here on the 5-second, right? You probably had a sell stop here, or he bought in on the doji here. On the 5-second, that doji is an actual flip. He gets in, waits for it to take one of these lows, shifts to break even, and he just trails the whole way down. 1 hour and 54 minutes. When price does violate this low, how long are we expecting it to continue going down? Most times it can just be going back to a previous area where it started, and it's going to continue higher. How do we know if it'll continue higher if it runs one of its older highs? So for example, right, here we had an SNDR on the lower time frames. This was an area that broke above this high, indicative of a strong potential area to take a move off of. Now, he was saying, like at the 1 hour and 54 timestamp, how do we know if it'll continue higher if it runs one of its older highs? So along this area, you don't see anything on the 1 minute, but on the 15-second you do. On the 15-second, the old high is here, and we failed at it. We failed at this old high. Specifically here. We tapped into his 50. Hell, you could even refine a little bit more. Say that that hidden supply area, the wick. We hit that former high. We do a candlestick structure shift, and we go below. That was our confirmation to continue lower. Because price already violated this low, this SNDR wasn't strong enough for us to put in a new high, and thus if you were anticipating and had strong conviction in a move down, you could have gotten in on this flip, or you could have gotten in on the violation of this SNDR, tapping back into the area that it left behind. 1 hour and 57 minutes. When it's going up or down, you can get involved on any side of the market, but you must know where you are. What is the current trend? What is market structure? The highs and lows that we're constantly seeing. That's what market structure is. Were any lows violated? If not, we're expecting a retracement into a continuation so it can create the next low. 1 hour, 55 minutes, and 40 seconds. So your entry is either the bounce to continue or the bounce to go short. The bounce for the retracement or the bounce to continue up. 1 hour and 56 minutes. So how do we know where the areas are that price will retrace from? Oftentimes, near former highs and lows. 1 hour, 58 minutes, and 9 seconds. When price is ready to go down again, what are you looking for? What's going to happen? You see a low violated as it taps into a demand area to go back up and then short to continue down. All you're looking for is opportunities to short now. 2 hours and 1 minute. One of the biggest issues we have is being on the wrong side of the market because we don't know where our former highs and lows are. And the violation of them is what gives us the next trend in that direction. It gives us the higher time frame retracement. 2 hours, 2 minutes, and 40 seconds. The market, if you count the pullbacks, you get 4 to 6 pullbacks, and oftentimes the seventh one fails. Sometimes 4 to 3 happens, then it's done and it reverses. So you count your swings alongside looking for violations, and usually the 4 to 6 one is forming around a designated area it's getting ready to reject from, and repeat the same thing. Now, I'm not going to sit here and say that 4 to 6 swings doesn't happen all the time, because it does. But what I am going to say is that if you get too mechanical in looking at 4 to 6 swings from a higher time frame perspective, right? Then in terms of your psychology, it could sometimes make you begin to force moves in that direction. I think 4 to 6 swings is best utilized from the lower time frames. Because look at this. If we go back to the entry that Dave was talking about, what signaled to him that he thought that price was going in the opposite direction when in that video he said that we were bullish or that he had bullish expectations? I'll show you what signaled him. 1, 2, 3. Stupid. 4. And if you think that maybe these are from a higher time frame, actually, I think I would count it like this. Yeah, I think I would count it like this. Yeah, because it's tightening up as it goes up. These are the seconds time frame swings, the candlestick structures. 1, 2, 3, 4. That's the 4 swings within this. We pull back, eliminate this low, and validates it. That. 4 swings. And then a doji forming on top of here, letting him know that price is weak. So just something to consider. That I feel like 4 to 6 swings is best utilized in confirmations when you're looking for an area like this to fail. And for the certain strength and direction of your current trend. That's when I think it's best utilized. But of course, everyone views the market differently. 2 minutes and 6 seconds. People wait for CSS flips without actually knowing where they are in structure. If you're in a zone, it's fine, but if not, what are you doing? 2 hours and 7 minutes. Our profitability is in the pullback. We had a place that was over in our lives, overvalued in our lives. The blessing was in the undervalued spot, so we waited for that. 2 hours and 8 minutes and 52 seconds. So if you want to stop trading retail support and resistance, you need to know structure. Retail is flawed, i.e. support and resistance, because ultimately it has you chasing price below demand and above supplies when we know that the market is primed for a pullback. Two hours and 9 minutes and 40 seconds. Ultimately, we know that oftentimes when price trades out of its range, it reverses and comes back into the range. So you're not looking for an entry above the last supply, below the last demand, in order to chase price in its breakout. 2 hours and 11 seconds. 2 hours and 11 minutes and 10 seconds. So the market does not run on support and resistance. And if you wanted to classify what support and resistance was, there are zones you can call support and resistance. And you can take these as entries, not from a position that's above a particular range slash POI. He's referring to multiple mitigated zones here before he probably conceptualized them. 2 hours and 14 minutes and 20 seconds. Sometimes, when demands are violated, we proceed to put in another high. So we must learn how to avoid this. He's referring to as absorption. 2 hours, 15 minutes, and 11 seconds. Dave is essentially teaching us real market structure with supply and demand on multiple time frames. 2 hours and 18 minutes. And in order to reduce risk, we need an understanding of multi-time frame analysis. 2 hours, 23 minutes, and 15 seconds. The market moves opposite of our impulse. This is why you'll lose most days. 2 hours, 23 minutes, and 50 seconds. Pullbacks happened at previous highs that were former pullbacks. The pullbacks happen within the former pullbacks. So the pullback on a bullish trend will happen at the area it pulled back on a bearish trend. And that's the end of video 1. At this point in the video, Dave asks if we are recording at 5 seconds, the very beginning. To be fair, he seems a lot more laid back here. However, I know he still has his moments within the playlist, i.e. the end of video 3. But even that video or other videos, for example, seem to be recorded at later dates. I think I was referring to here his change in his attitude towards people. If I play this clip.
There we go. Does it let you guys know we're recording? Yes, you are awesome, Louis, definitely. Alright.
I think when he said Lewis definitely, when Lewis said he was awesome, that he was talking about the late low-key Luis Lopez. Just speculation, but rest in peace.
Great, now we are recording. Ready for a double header. Yeah, that's how it's gonna feel. I wake up in the morning, I'm gonna be like, why did I do this last night? But it's cool.
So yeah, it seems I was definitely referring to that. All the way until 3 minutes and 50 seconds, Dave is just yapping. But if you look at his chart, you see the 50% of the last down move is marked consistently across all of his swings. So, for example, 50% here. Let's see. Oh, here. See the last down move here, 50%. You had a small SNDR here. He marked out the 50%. Last down move here, 50%. But here is when he used to ignore the wicks. And he had them consistently marked out. 4 minutes and 30 seconds. Dave makes sure we're familiar with / understand swing points. These are essentially a series of highs and lows in an uptrend. 5 minutes. And wherever you have a low put in that breaks above a previous high, it validates that low as a protected low. 5 minutes and 20 seconds. Now you're looking for price to come back into the range of the high and the low. This is the photo that he used. If you notice here, this would be considered the protected low. This would also be considered the protected low. This would also be considered the protected low. Now, remember what we said about the 1 minute and the 5 minute areas in video one and how they get tend or that they tend to get traded through. So the the more likely for a low to be truly protected, the higher time frame that low comes from, as opposed to taking order flow areas and expecting those to hold. 6 minutes and 20 seconds. Dave mentions that price taps into an area around these previous premium slash discount levels, and these levels are actually responsible for the break of structure. 5 minutes and 30 seconds, and oftentimes where price comes back into these areas, there are different areas along the leg of price that price reacts off of. 5 minutes and 40 seconds. Dave mentions the discount or premium area as an example. So for that 6 minute and 20-second timestamp, that was in reference to those two previous timestamps. So here Dave shows an example at 6 minutes and 48 seconds of a 1 minute break of structure, as he explains as well that there's usually an area in between the last high and lows that's responsible for the shift. Now this example in my opinion was a pretty crude example, because here this move that broke structure was down here. That price ended up tapping into to move higher. But oftentimes it's not normally here. Normally it's around up here, the last move that broke it. So for example, if we go back to this example from earlier before, this is actually considered the SNDR for the 1 minute break of structure above. Not this move down here, this smaller move. And obviously this is relative to the time frames that you're on and how structure presents itself. But it's always going to look different. For example, this is a higher time frame move. From the higher time frame, you might not actually see this fractal, so maybe this isn't the SNDR, but then you'd consider this as the SNDR, right? We tap in, deliver a move out of it. Now here, this is where we're going to get really advanced. This is closer to the origin of the move, of this swing. The origin of this swing is highly mitigated. It's down here. So if we take that mitigation, right, and we apply the area that it was left behind as a result of that mitigation, the origin of the move of this entire swing is now here. Price ends up completely destroying that move, and we get a move in the opposite direction, tapping into the origin of the entire move up down here, even though it was already previously mitigated. So those are very those are very key distinctions, right? And if we look at this move from a higher time frame perspective, like the 15-minute, let me just go down here. Oh, 15-minute isn't a valid area. 5 minutes a valid area. You'll notice that this is of a similar orientation to what he's trying to show us in video 2, where the S&D responsible isn't necessarily up here in this general area, but closer to the downside. And it's not, I did it wrong calling it a crude example, but if you look from the 5 minute, we did respond. Now we liquidated that fractal. So yeah, it's just something to think about. Not to say that this fractal is an SNDR, because it's not. This is the SNDR, it's what has the most volume. But again, it's really just something to think about. 8 minutes. He continues to say that if there are multiple S and D zones, oftentimes you can rule out the lowest, normally because the lowest typically has mitigation, or an imbalance, or S and D above. 8 minutes and 20 seconds. Dave mentions there specifically being an imbalance directly above the area responsible for the break above. 8 minutes and 40 seconds. Dave says to look for the last down move that broke structure to the top side. In this case, it just happened to be the origin which also broke structure as there were no down moves on the time frames on the time frame. In this example, we also didn't even reach it. We tapped into the imbalance 8 minutes and 30 seconds above, but we often return to this move before trading higher. So the example that he's talking about, or that I'm talking about, is in this photo here. This is the SNDR, but in this case we tapped into the imbalance above. It just also happened to be the origin of the move, of this entire move up. So they coincide with each other. And on top of that, similar to how we had a fractal in the example that I showed you in live price action that was above this, that could sometimes be confused and considered as a SNDR. It's actually very rarely that a fractal is the SNDR. So just something to consider. So at 9 minutes and 40 seconds, Dave introduces a very crucial concept. He speaks of the first tap of the swing area usually being a quick scalp, then the second tap being a double bottom before price continues up. This is a very crucial concept, and you're going to see as we progress through the playlist the variety of ways that this tends to facilitate itself across the lower and the higher time frames. Because a first tap of an imbalance, of a higher time frame imbalance, doesn't look the same as a first tap of, let's say, a candlestick structure flip. It doesn't. You have to know the differences between the two. And again, if we zoom out on the example that he's mentioning, this would be considered the first tap of the imbalance, right? But then this would be considered the second tap of the imbalance because we're tapping back into the same general area of it. However, however, if you notice, we didn't actually sweep this low here. So this was a very contentious point for me because I'm very, very exact in my thinking, right? And if you notice on this candlestick structure flip, there's a first tap here and then a second tap there. But then what came to notice for me is that Jay actually solved this for me. Under Jay's system, the shit show system, there's two different classifications of high probability sweeps. ISS, inside shit show levels, and SS, regular shit show levels. What we notice here is that this does create, oh, I don't want to get too in depth here, a shit show level, right? Because although in New York, this would be considered an ISS because of the volume that New York contains. In Asia, this is a legitimate shit show level. So then what happens? We sweep the shit show level. There's no more shit show levels here along this string of price, and we continue going up in the opposite direction. So again, just something to think about. Here we create a here we also create a shit show level. We sweep it, we bounce off of the ones high, and we continue lower. Shows us we're bearish, we're aiming for this shit show level underneath, and we go back in the opposing direction. So again, just something to think about. And if you're not familiar with shit show levels, um, go to Jay Intraday's channel, right? And this is my active narration of DTFX, my interpretation. So if you're not here to listen to my interpretation, then just get out. Get out. There's nothing left to sweep here. Our targets are inside of here. So we go up. So here at 10 minutes, Dave talks about how as price continues to move higher, there will be some swing points that price doesn't return back to. But just because price has not retraced here doesn't mean that you can't find a way to get into price. Here this is a 2. And within this, probably on a second's time frame because of this wick, we create an ISS. This would be a way to get into price. Based off of this body closure, you could definitely find a way in. Or you could take a 2 here off of the first imbalance of price. Once you see that it's beginning to do a candlestick stretch or flip, a more aggressive entry. 10 minutes and 40 seconds. If price never makes it back to an unmitigated area, most people are forced to sit out until it hits 10 minutes and 50 seconds. So now they're repeatedly trying to catch themselves as price constantly returns and pulls back, just so you can fit price into your narrative of it returning back to the area. A lot of people try to force shorts when price is continuously moving up, just so that they could get their idea of price to be right, that it wants to come back down. Hell, even I'm guilty of this sometimes. It's up to you as a trader to understand when you're doing things like this and to adjust and your narrative. Never marry your narrative. That's my note, my side note. 11:30. This is because swing points appear in a variety of different ways, and so it doesn't have to retrace back into that area immediately. 13:20. Most people will see the tap into this area and automatically think we're putting in another high. At 13:50, Dave goes on to explain the thought process behind people who chase long moves behind the intermediary lows. 14:50, and ultimately you'll come out with some wins and with some losses, but as opposed to trying to catch a bottom with the areas to the left, you're probably confusing yourself about. These areas to the right are actually the ones you should be focusing on and paying attention to uh, in terms of getting involved on continuations. 15:30. The areas on the left are really just for possible reversals, but oftentimes we confuse ourselves with the demand zones, trying to trade each one of them. 16 o'clock or 16 minutes. I'm sorry. Playing all of this trying to just catch a move going up when the market continues to play on your impulse, trying to catch a bottom as it continues your cycle of madness. He's referring to playing all the areas to the left. 17 minutes. We're confusing ourselves with these zones as price is coming down instead of looking for an area that's aligned with our right side slash trend. Now, a lot of the times we might be primed to play a move coming from a left side of an area, right? Because price is just super duper bearish and it isn't retracing back into our areas above. That is personally something that happens to me a lot. But there are still ways to get involved on this right side, like Dave said, even when the market isn't retracing back into your areas. You just have to figure out how. Now then, Dave doesn't necessarily talk about how because he talks about playing areas and zones specifically to lead you to your profitability. I'm not here waiting for an area on days that the market is bearish playing on my psychology. And that's why I trade using the shit show system. 1750. We're looking to the left and we're chasing the history in the past because we're trying to catch reversals instead of trying to get in on an area as it's going down. 1810. You'll see the reversal at whatever important area that price may come in touch. 1825. Within a specific area, like a supply or a demand area from the higher time frame. And this is true. 1845. So we're trying to catch everything from our areas down below when our moves from our areas on the right side are giving us more. 19, 19 minutes. We're trying to catch the bounce that turns into the longer move in hopes that it yields a larger return as the point of reversal. 1920. Whatever direction we're looking to trade to based on the higher time frame bias, we're taking one trade going in that direction and shifting to break even after just one structural low is taken. So, yeah, go to the next page. 20 minutes. So Dave is now explaining how at this point you can now play either sides of the market. 20 minutes and 50 seconds. So you could be coming down with a one lot size. Now when you're catching these scalps up, you might be able to do a quick 10 lot size. So if you take these scalps 2015 as we are going down, now you know these longs are only temporary. 2140. While this is just constantly reaffirming that we're making our way back down uh, towards the bottom side. 22 minutes. While consistently hedging price in these little areas with quick scalps that we're in coming down as a continuation from the last point, as being able to reaffirm that we're moving back to the downside as we continue to break structural lows or just lows in general because they wouldn't be considered a part of structure yet. 23 minutes. This is usually the trade that's coming out of the higher time frame area. 22 minutes and 20 seconds. Wow, I was really schizo while writing these notes. They're just all over the place. 22 minutes and 20 seconds before that, or you can just find areas that price comes back up to continue to compound going down. And then those trades that you're looking to come up from are usually the trades that are coming out of the higher time frame area. I'm sorry. 23 minutes and 15 seconds. But this one trade is usually from some higher time frame rejection. So this one trade is when you see the larger structural bearish or bullish flip. 23 minutes and 36 seconds. So now you're taking price down and you're anticipating with each pullback either a quick scalp coming up or you can play adding another entry in going down. 23 minutes and 40 seconds. Or after the pullback, you can play another entry coming down after it taps into whatever imbalance that may be here or S&D before you add another order to continue. 24 minutes. And now your profit from your order from the last continuation is now funding your second order directly below it. 24 minutes and 20 seconds. But this whole system can only be made possible by understanding market structure. And that's where I was getting wrong with the shit show system, right? Because at the end of the day, you know, I could play certain levels, right? But and I can play shifts in two failures. But at the end of the day, the higher time frame structure is what guides everything. It's how Jay even got the formulation for the basic structure of the shit show system. So until I learn how to navigate structure and understand how to use structure completely within the shit show system, it's in my best interest to keep on using market structure until I understand how the shit show system facilitates itself entirely, and that's why I'm doing it like this. 24 minutes and 30 seconds. Although these S&D zones are not zones that are responsible for structural breaks, these S&D zones oftentimes serve. He's speaking specifically about any given zone, high or low, that's left behind when price moves out of the area. Price can come back into it sometimes and then leave, but there are times when price doesn't come back to it and continues to trend up. So this is what he drew as an example as to what I said in the 2430 timestamp. Price and then at 2515, price can sometimes come back into this area before leaving, but there are times price continues and doesn't come back to it. If I continue to the next page, we're looking at 27 minutes for the area responsible for shifting above this, because this area is where we will tap into and then take another leg up. This is the bullish area price is looking to make its way back to. 2811. Price can still give you reactions off of non-responsible areas, but these areas are normally to take you for a quick scalp bounce to continue the overall trend. And below that area price tapped into. 2840. So there repeatedly are people who continuously are looking to buy into price rather than understand that the market is looking to respect the overall trend. 2920. So you can buy the bounces and sell the trend and time those reactions and create a system around it. What he's not talking about though, which is like an extreme caveat, is that these origins and these S&D responsibles are still capable of not generating the larger trend. Just because it bounces off an S&D responsible from the higher time frame doesn't mean that price has to continue going in that higher time frame direction. If you want an example, look at like the last week of price action of the first week of March. Continuously we're going through higher time frame areas to our left side, but regardless these are only generating bounces for us to continue going down. So in reality, you should be anticipating these higher time frame areas to generate the larger time frame moves, but only within given confirmations. That's just the truth. What are these confirmations that I'm talking about? Here on Solana, we tapped into an S&D responsible for the higher time frame move, right? And Solana is tanking now. But my alert hit here at the 50% of this S&D responsible. Now, just because my alert hits at this S&D responsible doesn't mean that I think it's going to take the high. That's not what that means. What I'm looking for within here is specific confirmations. So this is from the 4 hour, but if we go to the 1 hour chart now, if you notice here, we had liquidated the opposing SNDR responsible. Now this is a fractal on the 1 hour, so really it's not an SND responsible, but it is an SND responsible for this inside structure. That's an early confirmation, and this is something I love doing from the higher time frames because it solidifies it more. If you notice, once we liquefied that SNDR, it created a transfer of power, in which now this fractal became the new SNDR. I have receipts. I put them up on screen as proof. I texted my family in a group chat, combined with a fundamental understanding of what Donald Trump was going to do in the next month, etc., etc. I had texted them that from here, Solana could potentially put in new highs. I said even an all-time high. And even then, though, the all-time high shouldn't necessarily have been considered until we got strong body closures. But considering the time, Dave says not to use time, but for market forecasts, time is very important because we were just before the pre-market and market open for New York, and we were coming into this area. And normally the volume is tends to spike up in whichever direction price wants to deliver to. So I told them that if they would have listened to me, they would have been able to catch that entire move up. But like I said, I'm not looking to get involved here. This is only when my senses are primed. Now, if I only wanted to take a quick bounce to potentially the next high, then I would get involved here, and then I would look for confirmations along the way for taking the high. But if price wasn't moving as strongly as it did, there's no reason for me to shift to break even from here, or for me to continue not to shift to break even, because you want to shift to break even as soon as possible. But there's no reason for me to expect this high and expect a longer move, meaning no reason to not take profits here. So yeah, that's just a little case study. So I don't know if I already said this, but 27 minutes. We're looking for the area responsible for shifting above this, because this area is where we will tap into and then take another leg up. This is the bullish area price is looking to make its way back to. 28.11. Price can still give you reactions off of non-responsible areas, but the areas are normally to take you to, or to take you for a quick bounce to continue the overall trend. And below that area price tapped into 28.40. So there repeatedly are people who continuously are looking to buy into price rather than understand that the market is looking to respect the overall trend. 29.20. So you can buy the bounces and sell the trend, and time these reactions and create a system around it. 29.40. If we reject from a higher time frame area, we know it'll be a heavy rejection going into some higher time frame area in the opposite direction the rejection is happening from. 30.20. There are areas that you can get involved where you don't have to utilize the current trend, or you can. It truly depends on how you see the market, but utilizing the current trend will always give more value. 30 minutes and 45 seconds. It's much better to catch a trade from an area you're expecting to break structure to the downside, so you get a discounted move and then some. 32 minutes. Dave explains the importance of charting out important areas previously using the example of a miscalculated imbalance, putting in a new structural high. Miscalculated imbalance. Let's see what I'm talking about here. Okay, if you're trading NQ, that point is not something to pay attention to, because NQ tends to fill imbalances. So unless you're trending strongly, that's the only times it respects imbalances. 32 minutes and 15 seconds. It's giving you an explanation for everything price reacted off of and why price retraced, where price retraced to, and where price continued down to. 32 minutes and 30 seconds. When you begin to see price move over and over again in this fashion, you begin to become confident in playing different sides of the market, only relative to that one rule you have. 35-38. Within certain trends, there are swing points. Within swing points. For the following examples, let me go continue. So remember, a swing point is the area left behind after price breaks a high or low. Dave uses the term swing points, structure, and zones pretty interchangeably, but it's important to know the nuance between each. But the main difference I'm able to take away is that what separates swing points from regular market structure is that swing points aren't separated by time frames in the same way market structure is. Meaning that when Dave talks about swing points in his examples in the original Masterclass video, he could be talking about any zone from any time frame. But market structure is in specific reference to the higher time frame usually. Now, Dave uses market structure in 2025 enter as a universal concept. He doesn't tend to distinguish the two as he does in the original Masterclass playlist. Because as I showed you before, using the lower time frame example for the 4 to 6 swings, he can refer to that as structure too. But that's really order flow. It's not really market structure. And even now, I think he would make that important distinction. Structure pertains specifically to the time frame you're trading on, but swing points can account for all structure across all time frames. That's also true. You could have a higher time frame swing point. Um, and structure can actually pertain to the specific time frame you're trading on. So all the points that I've said before is true, but you have to know to understand the differences in which Dave is talking about these things given the context in his videos. 36 minutes. This becomes super useful because using swing points you can see how we begin to attack the higher time frame trend slash structure from the lower time frames. In this example, Dave is talking about how none of these swing points look the same. This is the reason why. And notice how in this example I use swing points in specific reference to the lower time frame, even though they can account and be used to explain higher time frame market structure zones. But for most of the playlist, Dave is using swing points in reference to the lower time frames. But in 2025, Dave talks about structure a lot from the lower time frames as well as to how he takes his entries. He's just changed his verbiage just a little bit. It's a semantic point, and it doesn't really matter that much if you don't understand what I'm talking about right now, but it's cool to understand if you do. So at 38 minutes, Dave goes on to go over internal swing points on candlestick structure and how they relate to the higher time frame swing points. At 38 minutes and 10 seconds, Dave goes on to call these outside lows slash swing points institutional swing points. As when these are violated, that's when the uptrend is getting ready to shift and assume a downtrend. It should be important to note that he's looking at these institutional lows slash highs from the 15-minute. Now then, this is the example that he's talking about, right? How with each high and with each low, it creates an institutional swing point. Now, it's important to also note that these aren't necessarily 15-minute down candles or 15-minute areas. He's just looking at these areas from the 15-minute as a guide for the 1-minute areas and the lower time frame swing points that could potentially be violated. So, within here, right, you will have 15-minute areas and 15-minute down candles, but these might actually be more like 30-minute down candles or maybe even hourly down candles, which translate to hourly zones. But as you notice, the fractals, uh, well, there aren't any fractals here. These little areas here, if I can't really tell from here, if this red candle went underneath the green candle low, then yes, this is a 15-minute down candle, a 15-minute zone, in which price tapped in and bounced off of. This isn't a 15-minute valid zone. This is more like a 5-minute or a 10-minute area, and that's why price liquidated it here. If you look here. So yeah. This area here we could consider as a 15-minute area. This entire swing down here, right? But I went back and I looked to see if this was a 15-minute area, and it's not. It's not a 15-minute valid area either. This is an area that you'd see more likely on like the 1 minute or the 5 minute. But it's within this 15-minute down candle here. And because of that, we tapped into it, the 50% of this higher time frame area, but more specifically, we tapped into this area over here. Dave might say back then, looking at this chart, that it's the second tap of this higher time frame imbalance, and then we leave. So you might be asking yourself, why didn't price return back into this area? Well, if that really is just the second tap of the higher time frame imbalance, then we actually tap directly into the 50% of it, and which price also had an unmitigated 50% of the higher time frame area. So with that being said, right, imbalances at this point in time in NQ tend to get filled. NQ just be moving extremely volatile, or in an extremely volatile way. But we got the second tap here of this imbalance, and then we dipped. I could tell from the 15-minute, right, there might be some shit show levels on the downside here, but our targets were either, if you want to consider the 50% of this area to continue the trend up, or if you don't like viewing price in this way and viewing it in terms of imbalance taps in which they're already fully mitigated and almost completely filled, you can view it like this, where you could just simplify it and view it like this, where price was looking to fill this entire imbalance after it failed to put in a new high, came back down, and then mitigated the 50% of this area, in which now you're looking for confirmation in the opposing direction. From the 15-minute, right, we're getting a CSS confirmation. We tap into this imbalance on the 15-minute, which is a 1-minute low here. Get a second tap into the 50% of this imbalance. Doji forms. You can get the move to leave. But again, this tap here, you're only looking to take this tap given a lower, even lower time frame confirmation. And if that's the case, you don't know if we're going to fill this imbalance and then continue back down. You do not know that at all. At all. You do not know that. We don't even have to fill that imbalance sometimes. Sometimes we could just tap into the 50% of this imbalance here and then continue back down. That's how much uncertainty you don't know. You don't even know if we're going to go above this candle. That's why if you're taking lower time frame confirmations, you want to use it based off of high probability areas like this imbalance fill and a tap into the 50% of some higher time frame area like Dave was talking about. Now, again, if we really are considering this a 30-minute area, right? Because he's looking at this area from the 15-minute, meaning that it could even be an hourly area, and this is actually considered an hourly area, or I'm sorry, a valid area, not an hourly area, because I'm not sure if it's an hourly area. It could be, but a valid area because we took this high and then put in this low. Or I'm sorry, we took this high, put in this high, and then put in this low. It's considered a valid area. It's a high probability expectancy for price to deliver a one-to-one to this area. You could then take that, given that you wait for this imbalance fill on NQ to go up into this area, but you have to be looking to shift to break even as soon as possible, especially with this narrative. Because what's this narrative? What is it? It's a V-shaped recovery. So yeah, just something to consider. And before I continue with the rest of this, I'm gonna be honest with you. In my notes, in my my extensive notes, I don't think I actually have written down anywhere in which he talks about a valid area or a valid zone being created. But he went over this in his mentorship. He claims that he went over what a valid area is in price in his original masterclass, but I'm sorry, I have written so many notes down and I just haven't seen this at all in the original masterclass. But what I will say this is that he did say it in his mentorship, and he did say it was in the original masterclass in his mentorship, but it's just nowhere to be found in my notes. I'm sorry. So that's the one aspect. If it is somewhere in the original masterclass, I'm not going to completely discount that. It might be. I might have. I probably. I might have missed it, but I couldn't. I couldn't find it anywhere in my notes. So with that being said, the valid areas are just the higher probability zones to be taking from the higher time frame, based off of what I've shown you guys. I guess I could go over it real quick. This is what a valid area is. So specifically, it's an area in which we have a green candle that's put in, right, with a high, in which the next candle takes that high with a wick, and then finally we take the low of the green candle. It closes and it leaves behind a zone. That's literally all it is. These are the higher probability areas of price. And you see them form a lot around origins, but a higher time frame zone can also look just exactly like this as well. And it's the same, the opposite in the other direction. And that's why I said this is a valid area, right? Because this area here, that high was taken out by this high, was taken out by this high, and then we put in a low below this candle low. So most likely from the higher time frame, this is a valid area. Just something to consider. 3940. Davis telling us that it's imperative that we learn how to utilize swing points. 3950. So with institutional or regular swing points, price oftentimes will go above a particular swing, come back to it, and trade higher. 41 minutes. Dave gives us an example of a 15-minute fractal SNDR and tells us this is the zone we're looking to trade from. And it's important to note that that wasn't a 15-minute fractal. A fractal doesn't look like that from the higher time frames. That was probably more like a 30-minute fractal, something like that. Not a 15-minute fractal to be exact. But on the lower time frames, it's a whole S&D zone, and it's most definitely considered a swing point. 4120. When price has already began shifting bearish after tapping into a higher time frame area from above, usually the SNDR won't hold. But we aren't really concerned with the higher time frame. Price is still expecting to give a reaction, irregardless of this possibility. So he's talking about specifically in this example, right? And remember how I told you that and Dave has said this himself, that it's very rare that a fractal is the S&D responsible. This isn't a fractal on the 15 minute, but on the 30 minute it looks like it is. And I wouldn't necessarily even consider this the S&DR responsible, if I'm being honest. The real S&D responsible along this entire move of price is down here from the higher time frames. It's here. This is the last high. One of these highs is the last high. Either this one or this high. It's probably this high. And this is the S&D responsible that's likely to hold. And what he's saying is that when we shift out of a higher time frame POI from somewhere up here, you shouldn't necessarily be looking for these S&D responsibles to hold anymore. And that's true as well. Like the S&D responsible is one of the most powerful moves in the market. But it's a move that's designed to send price higher. But as Dave said in video 1, the real move that you're looking for the most powerful moves is going to be the highs and lows of specific areas. Meaning this S&D responsible coinciding with the origin of this entire push up. So it would be this right here that you'd want to look for a really strong move up. And the key distinction here is that the S&D responsible is relative to the time frames you're trading on. The higher the time frames you go, the more likely you'll see that the S&D responsible is just rested within some sort of imbalance. So what we know about NQ is that imbalances tend to get filled. So here he's looking at, I think, crude oil. But in reality, right, like if it's not NQ, I would just not yeah, I'm editing this video and I'm looking back at it, and actually, like, I think I made it over a bit over complicated here. Um, the truth of the matter is that, like I said before, the S&D responsible from a higher time frame is just going to be an imbalance. But, and I wouldn't really consider this the S&D responsible anymore because of what Dave said by the end of this video about the last move up, the last move down, the last down move, as you're looking to trade from as a refined area from within your higher time frame down move or swing point. The last down move before price traded up being the move origin. So this wouldn't be considered the S&D responsible. But like I said before about the imbalance thing and the S&D responsible just being an imbalance basically, it's really just the case that an S&D responsible is a lower time frame down move before we trade higher. That's honestly the case. And in the examples that I showed from Friday's price action throughout this video, the specific 1 minute example that I showed especially, you'll see that that's not actually a fractal, that's a down move. A fractal is a lower time frame S&D zone. but we see that as a swing point visible from the 1 minute. So I think later on in the video I get confused on that point. But that's not a fractal. That's a doji, but it's a down move. So yeah. 4120. When price has already began shifting bearish after tapping into a higher time frame area from above, usually the SNDR won't hold. But we aren't really concerned with the higher time frame. Price is still expecting to give a reaction, irregardless of this possibility. Now, if we're thinking about it from the perspective of what he said earlier in video 2, if you want to operate with the highest expected value and the highest probabilities, then you don't necessarily want to be taking that bounce unless you have that experience to take that bounce. And in the example that I showed you before regarding the V-shaped recovery, personally, if I'm being honest, and taking bounces in scenarios where we're extremely bearish like that coming to the area, it's a lot harder to take a bounce like that, and it makes you rage. I'm not. That's why I'm getting a little bit angry talking about this. But anyways, 42.35. But if price does continue through these areas, it can give you a bias that the rest of the area is lunch meat, but only after price moves through with bodies. And that was the example that I gave you earlier with Solana. 42.55. With the area's price left behind without giving a tap slash mitigating, you'll see on the way back down, price will give reactions out of most of them. Dave continues to not just mark the S&Ds, but the areas comprising all of them. 42.20. These are areas where your quick scalp opportunities will come from. And I do want to note that although I have raged looking for, I guess you could say, quick scalp moves moving into the opposite direction, a lot of the times I only rage because I'm targeting too much. A lot of the times those moves actually do end up giving a reaction, but like I said, you tend to bite more than you can chew in those situations. Um, 44.20. These are where your quick scalp opportunities will come from. Overall explanation. We're looking for a tap at the 50% to take us up for a potential move. The right here is a swing point. The high and the low price trades above and doesn't come back into it. You're looking for those types of unmitigated areas. And I drew something in my notebook describing this from the 15-minute. Oh, it even looks like a valid area. Oh, wait, no it doesn't. It doesn't even look like a valid area. That's funny. But it should be valid areas that you're looking to trade from. 46.33. Swing points can be utilized as a form of directional bias and reversal. 46.40. Dave shows an example of a swing point 50%. 46.50. Dave shows how to get involved on smaller areas within the trend. Let's go over that real quick. So these are all the various swing points that Dave marks out. We go just a little bit behind here. You'll notice that he's marking out all of these specific areas, right? You have this swing point after tapping into this 50%. In case you missed it, you could get in right here. You have this one that it trades through, and then this one right here. I think he marks out and you're looking for price, and he says that you're looking for price to tap into at the 50% and then trade higher. Now, in this case, right, this isn't a body as of yet, but here price taps into the 50%, trades higher, etc., etc. He's just using this swing point specifically to let you know that the way to get involved on these smaller swing point moves would be to just place, well, he doesn't really like limits, but to get in at the 50%. So for example, I'm showing this example a lot, but it works. On the lower time frames, this is a swing point. Now, this is a doji here, a regular down candle, but on the lower time frames, it's a swing point. Here, you get involved, place your limit here, and then you go back up in the opposite direction. Uh, Again, let's say you missed the move coming out of this area to the left, right? What you would do, get a box, wait for the formation of a swing point, taps into your area, and then it goes. I wonder, oh yeah, we swept that SS. Yeah, we swept that SS to the tick. There is a shit show level here that we swept, and that's why price was looking for this before we traded in the opposite direction. We had other targets up here, multiple mitigated zone here. We're looking to continue to trend downwards. I can't wait to master this system. Just to be clear though, if you notice, bro, this swing point here is of a similar orientation to this one here. So he's looking at this from the 15-minute obviously, but price is fractal. Price is fractal, so it's the same thing across all the time frames if you know which areas to get involved in. So that's what he's saying, like you could get involved on these lower time frame little swing points if you really wanted to. You just have to know which ones to choose. Yeah, so like here, if you notice, he's saying like when price trades above, we tap into the area and we leave. Um, this is a 15-minute area. Like this is actually a 15-minute valid area, and it was mitigated on the way out. Meaning you're not looking to take a trade from here. You're actually expecting this area to fail after we put in these highs. And then on the lower time frame, you know, you don't want to front run equal highs, right? So around here, you'd want to look for some sort of opportunity to short once this low here is taken definitively. But if you notice, we get a reversal pattern here to trade in the opposite direction. So I will say this, that these are technically, like on the lower time frame, this would be considered like a 1 minute body closure, right? But that's again a wick on this higher time frame. So you're expecting this type of zone to fail, but what do you do in this type of situation? Most likely you're sitting out. I'm gonna be honest. You're sitting out, you're waiting for price to give you something else. That's the only thing you could do in this type of situation, because we take this low and immediately price shows us a sort of reversal pattern on the lower time frames. And a lot of people, they'd want to take a market structure shift here, right? To tap back into this area and short down below. But obviously in a bullish trend, which we have specific targets towards the upside, you're gonna get smoked doing something like that, trying to front run the real market structure shift, which is gonna come from one of these valid areas down here, probably this unmitigated area here. If we shift below this 15-minute area here, that's the real market structure shift for intermediary shift, and that allows us to know that we're looking to trade lower. But in this case, if you would have tried to front run that, you would have gotten smoked here. You would have very much gotten smoked. And this is what Jay talks about in his shit show model, where he tried to take the market structure shift, but every single time he got smoked. So under under Dave's system, you can't take any trades here. You just can't. But under Jay's system, what do we know about this? This is the 15-minute. So most likely this is some sort of SS level down here. This is an SS level. We come up, we come down into this area, mitigate this fractal, and we trade higher, knowing what? We know that even if down here at this level, I could tell from the candles that this might be an SS level. It might be an SS level down here somewhere within these levels. And you know what? Why don't we take a look real quick? So this is the example Dave was showing, but from a 1 minute perspective. So under Dave's system, there's no way you could be able to take a trade like this. But in Jay's system, we actually swept the last SS alongside this leg of price in this continuing uptrend, right? If we go back to the 15 minute, so you guys can see. This is the zone Dave had on his screen. So if you look, all the S&D zones that Dave was talking about before, you had this one. I think the other ones you were looking at was in oil, actually. Yeah. If you notice, right, we just had a continuing uptrend, right? 15-minute areas constantly being created. Right here, for example, we had one right here. Yeah, because this low into the high, into the low, high, we took out this low, put in a new high. 15-minute areas being consistently created. And they was talking about, let's say you miss this area, then you have all these other potential areas that you could get back involved in. He marked out this one. He marked out this one, which price traded through. Under Jay's system, you're not able to take the 50% of this area, right? And price did end up coming back to it. But what do we know about this already? That it's already mitigated. And wow, fractal from the looks of it. That's funny. But from this perspective, right? Under J's system, what do we have? We have an SS here that's created after we take this high, and no SS's on this downside of price. Absolutely none. So what Dave is talking about here, when like you're looking to short because your ideal was wrong, because you have everything underneath and you want that zone to be taken specifically at this very moment, no, just follow price. And with J's system, you don't even have to wait for the mitigated area or for the body closure above. You just have to find the right sequence. And here there's no SS levels underneath. Like I said, we tap into this and then we go. And then we go. And then if this zone fails, then it makes a market structure shift. This does make a market structure shift. I was wrong in my earlier explanation. This does make a market structure shift if this fails. We come back underneath this low. But it's a lower time frame market structure shift. And the actual 15 market structure shift you were waiting for is down here. So no, I'm not actually wrong. And that 15-minute market structure shift is correspondent with the S&D responsible of this area, which lets you know that we could low-key be looking for this low here. And if we don't get that low, then what? Then guess what? We're bullish. But if we do get that low, then it makes an even higher time frame shift. And then we pull back into the area again. And then we come back down. It's pretty cool that way when you start explaining it. And basically the trend just starts to look like this. And then you have a whole higher time frame area that looks something like this, in which you get a big pullback to make something that looks like this maybe. And if you look at it from the hourly, If price decided it did want to do that, then what do you have? A true market structure shift coming from out of here. Maybe from the 30-minute it's more visible though. 30 minutes way better. So yeah. But that's only if we take one of these lows from the lower time frame first with bodies. Hope that made sense. And to prove what I said earlier in my previous example on TradingView is also a swing point, i.e. this. At 49.30, Dave says that this is also a swing point as well. 51. If you were to take the 50% of the larger swing point and find the swing point slash imbalance within it, you would end up pinpointing the exact area price is coming to tap into, with the overall bias that the price was looking to tap into the 50% of that area and leave. 52.27. What you need to understand with these swing points is that the larger swing points are more likely. The smaller swing points are easier to break through. 52.45. Dave explains that the swing points you see him mark out are just supply zones slash order blocks from the higher time frame. 53.25. This is also why you should be willing to utilize fractals as zones as well. 53.30. Swing points are supply areas left behind. $54.20. Dave shows how he would have refined an entry to get less drawdown as price taps into the area and the trades below. 54.35. With swing points, you can utilize them as directional bias from the higher time frames. 55.10. So now when we're shorting, we have a direction on where price is going to, but we also have an area from this 50% of where we can potentially narrow down price doing something in there. 55.40. So really, we're looking for price to come in and tap into anything below the 50% or at it. 55.50. Dave talks about the S&D zone in its particular location from an hourly area. It's important to note that he disregarded the fractal S&DR above, something to keep note of. Let me see. So when I had first originally taken these notes, I had like these fractal S&DRs that I was thinking about marking out. But like I said, it's very rarely that a fractal is an S&DR, and really this here could be considered the S&DR, but it's up to you. Like, this is considered the last down move, and you could get a reaction out of it. It's likely. But is it going to continue the rest of the trend up? It depends. Depends on if it wants to do that and if you get confirmations along the way. And I'm just now realizing that this is an hourly area here. It's more like a 4-hour area in which price had this hourly fractal. So on the lower time frames, it is a valid area. You could consider taking, or most likely a valid area, you could consider taking an entry from this. Let me just make sure. Can't tell from here, but I could check. So if you look from the 15-minute, it is a valid area. I checked. This is a replay from that same exact video. This is the area he's looking at in particular. You can expect a good move off of this area, given those requirements. 5630. The area that broke structure is the one we're looking for, but how do we know price won't tap into any of the areas above? Price can tap into those areas, but guess what these areas would overall end up being? Just reactions and bounces. The targeted area that we're expecting price to reverse from is the SNDR, and the larger move is the more likely swing point. 5820. So this should get rid of the thinking that makes you expect price to reverse from areas that aren't designed to take price further. 59. But not only do we get our scalps up, but we also get our rejections to come down. 5950. Price can be prevented from tapping into your POI if there's an imbalance above it. Areas that are likely SNDRs, choose the imbalance. On NQ, imbalances tend to get filled. Remember that as a side note. Now, the reason why I said fractal SNDR in previous examples, Dave said that it's very rare that a fractal is the SNDR, but the higher the time frame the fractal belongs to, seems to be the case that it operates similar to an SNDR. Now, mind you, if we're looking at it from this time frame's perspective, then what you'll see is that this is the actual SNDR within this sort of origin, right? Now, what ends up happening is once we're inside of here, right, we liquidate this SNDR or fractal SNDR as a possibility from a higher time frame to move higher, and then we wick below it from the higher time frames, from let's say a 30-minute time frame, and we immediately go in the opposite direction. What I've seen is that these like fractals, they tend to, or these SNDRs, they tend to become MMs like this, right? When we get some sort of sweep, and I'm not going to explain what an MM is because that's not free masterclass material. But this is just to highlight my last point, just so that I don't go crazy like doing this, is that it is very rare that a fractal is an SNDR, especially from the lower time frames. But it doesn't mean that it can't be the case. And we see that here because this would technically be the valid bearish area. We tap into its 50% and then we leave. So it's nuanced. Another thing too, if we do count this whole move down as the origin of the move, technically this is the SNDR, right, of this higher time frame area. We could consider it the origin, but let's just consider it a higher time frame area for right now, because this is an even higher time frame origin, but we'll just consider it a higher time frame area for right now. What he said, if we go on the hourly, this would be considered the origin here. inside area. Say we go back on the 30-minute. This being the last down move on this time frame. What you'll see is that instead of tagging any of the areas below, like I said, we fill the imbalance. So again, you also do want to consider these higher time frame imbalances, because the higher time frame imbalances are more likely. But from the 1 minute and below, it just seems to be the case that NQ seems to fill these imbalances, and it did. It did fill this imbalance. We gotta tap into like the very beginning of it before moving back up. If I take away this middle line, you can see. Right, I took away the right one. Oh, it's the 50% line. You'll then see that we tapped into the very top of it from here, right? Into here. We move up and then we move back down to fill it. So it's still the case that like imbalances tend to get filled, but you still want to consider the fill of those imbalances as the real move up, as opposed to it may be considering that entry to retrace deeper into the demand zone itself, like right here. So that's a new slight nuance. And a further point that I do want to make is that Dave said that these areas would overall just end up being bounces and rejections until we finally reach this point here for us to get the real move up. Well, in that very example he said that in, if you look, price gave us a very heavy rejection from outside, from just the very tip of this imbalance. So it doesn't necessarily have to be that way either. Like, just because you have an area down here, like what he said in the earlier of video 2, doesn't mean that it has to come back down to that area that you marked out. And that's one thing, because that's a very clear contradiction in what he said. Like, very, very big contradiction there, because he literally said that if you have an area, any given area from a time, from any sort of time frame, right? A lot of people, they're looking to try and short from these areas because they have a bias towards any specific area that they have on the downside. Meanwhile, he's literally telling you to short until you get into your designated area. So that's a very big contradiction. And the truth of the matter is you don't know if this area is ever going to get reached. So why are you formulating a bias based on that area? That's just the truth. You have to follow what Price is trying to tell you. And with that being said, we'll continue. And to solidify that I'm not lying, he said 58.20. So this should get rid of the thinking that makes you think or expect price to reverse from areas that aren't designed to take price further. 59. But not only do we get our scalps up, but we also get our rejections to come down. 59.50. Price can be prevented from tapping into your POI if there's an imbalance above it. Areas that are likely, S&DRs, choose the imbalance. And what I showed you was US 30, but on NQ you want to expect that imbalance to get filled before the real move up, and then consider getting into price. 1 hour and 20 seconds. This is why Dave mentions imbalances are greater than S&DR, and to choose the imbalance that's there, even if sometimes it reverses off the S&D. 1 hour and 1 minute and 31 seconds. So you want to get used to the reactions that occur within these areas, because a lot of the times they can turn from quick scalps into larger moves. So you want to get used to understanding the reactions that are in these areas and how to capitalize off of them. 1 hour and 2 minutes. Within higher time frame imbalances, price tends to drop below the 50%, and to brace yourself for some drawdown if there's any. 1 hour and 3 minutes and 40 seconds. What changes Dave's bias from a scalp to a longer move is a structural break. 1 hour and 4 minutes and 20 seconds. Dave shows an example of a swing point breaking structure with a wick and tapping back in. 1 hour and 5 minutes and 50 seconds. Dave speaks upon a common occurrence and causes us to get break even, and how understanding structure, intermediary structure, candlestick structure is important, and to utilize all of it. 1 hour and 6 minutes and 20 seconds. The requirement to get in on the balance taps that occur at your areas are if price does a candlestick structure flip. The imbalance essentially creates a swing for us to take up and leave. This is the example he's talking about here. If we go back to the other chart in which we see that price didn't return back to that S&DR, god damn, them shit stink. Jesus Christ. What the fuck? If we go back to this example, how do we know to get into price here? If you waited for this structural break above, you would have been too late. What we do have is we have this S&DR, this last down move from the 5 minute, and we did tap into the S&DR that ended up liquidating that S&DR, but not even the 50. How could you have gotten earlier confirmation to potentially take it a little bit higher? Taking a CSS flip here is risky because, for one, you're not within the 50% of the area. You know, Dave has recently released how to separate uh, true imbalances from just fair value gaps. He's talked about that as well. And I'm starting to see now that this might be an assess level. But anyways, how do you know outside of that that you want to take a candlestick structure flip here? If we go on the 1 minute, again, you don't want to take the candlestick structure flip here, because if you do that, well, you don't know if it's going to go down there. could do is that you could wait for that 1 minute break above, tap back into this 1 minute imbalance, in which I believe it's also a 12 minute. Yeah, tap into that 12 minute imbalance right here. Stop behind the area or buy stop and then go. That's one way to look at it. And let me just make sure I'm not saying fake news one more time. So yeah, that 1 minute, forget the 1 minute, go on a higher time frame, look for that imbalance, look for the candlestick structure flip here, and then go. And this brings me back to my earlier point about heading into a higher time frame area and we begin to consolidate. Most of your entries, you want them to be in confluence with a higher time frame area, and based upon the tap of that level, hitting and then going in the opposite direction. You have a candlestick structure flip inside of here. You could take that and you could take it for the longer move. 1 hour, 8 minutes, and 30 seconds. Swing points work on higher time frame. Proceeds to show us an hourly area with refinement at the 50% using an imbalance. 1 hour and 9 minutes. So if we wanted a higher time frame rejection, we would just use a higher time frame swing point. 1 hour, 10 minutes, and 40 seconds. Why not choose an imbalance above? Dave goes over a specific example as to why he and where he shows why price won't go higher and why he targets a specific imbalance at the 50%. Let's see. So he's using this example to show that price, there's no volume up here, and that's just price going straight up and straight down, and that this was the imbalance that he would use. I do want to say on NQ though, I've seen it. Bro, this imbalance, you would get smoked. It would fill all the way up. It just would, and then the real move would come. So in this specific example, you don't necessarily want to do what he's saying in this video. You would want to use up here because you should expect that imbalance to get filled before the real move. 11:11. What the fuck? Oh, no, 1 hour and 11 minutes and 10 seconds. Consolidation is important because when that area comes back to be tested, then you usually get a reaction out of the area. 1 hour, 15 minutes, and 30 seconds. What you need to understand here is that sometimes price doesn't come back to touch these areas, especially the smaller swing points. 1 hour, 15 minutes, and 50 seconds. He shows an example of a swing point just barely being taken out. To avoid getting caught up like this, to utilize the swing points with the most consolidation. So this is the swing point that he's talking about. And before we continue, I want to go back into his former examples in which he was outlining a bunch of random swing points. Do you remember this tiny swing point here that he said got traded through? Hold up. You don't want to use swing points like these, right? Because they don't have volume to them. You want volume. This is like a 1 minute area, if that. And that's why it got traded through. It delivered 1-to-1 on the area real quick with a wick, but then it immediately got traded through. Um, and if you look from our earlier examples, if I go back on the 1 minute, this area also doesn't have volume to it, but it was still capable of generating a very large move. Why is that? Because his logic still applies, right? Where if you miss the move from before, from earlier, from this origin down here because it was mitigated, let's say, and you decide that price is looking to trade higher, given this bullish momentum, given the context of it, you can decide that this area is actually high probability. But that only comes with experience. You can't do that otherwise. Especially because this isn't even a 1 minute valid area. This is a seconds time frame area. The 1 minute valid area is this entire zone. This is a 1 minute zone. So yeah, something to think about there. And yeah, that's it. 1 hour and 18 minutes and 35 seconds. If you utilize these swing points in these areas to scalp, you can hard partial at 10 to 20 points to create a discipline. 1 hour, 20 minutes, and 30 seconds. Dave gives an example of a demand area that's not only an origin of an intermediary swing, but the SNDR of said swing as well, fully unmitigated. 1 hour, 21 minutes, and 30 seconds. These tiny areas that price leaves behind are usually areas that the news trades to. Let's see what he's talking about. Wow, I completely forgot he had said this. This is actually really big because this corresponds with a lot of things. I want to go look at this. Where is this? The 22nd. Oh, don't tell me that's the 22nd of June. Let's go check it out. Let's do some investigation. I do also want to say before I show his specific example that in this price action, I've been using this price action for like a lot of examples. It wasn't even, I think it was Friday's price action, but whatever. The news actually did trade to the tiny area. This is 9:30. So again, what he's saying is reigning true. This is literally 9:30. It's a tiny, tiny area, and even up here, that tiny little fractal too. Of course, this corresponds to the imbalance that broke structure, but on a higher time frame. But again, it traded here to 9:30. We're at 9:30 before putting us and taking us up here to this little tiny move before giving us the big move down. And this is what Dave based his entry off of. And again, it's these tiny little areas that price tends to move off of during these openings. Oh yeah, and this is an SS level. So this is the example here, here. Now I went back and I looked at it, and this is in a multiple mitigated zone, right? I'm not gonna say the purpose of multiple mitigated zones, but if you look here and here, there was an SS level rested right underneath that multiple mitigated area. Now, outside of the immediate order flow that we have, I don't really like using SS levels for direction because the moment, whoa, why did the screen turn on? Okay, it turned back on. I don't know. The moment that I start using SS levels to dictate higher time frame moves, then I started thinking in my mind, oh yeah, what if we have these SS levels over here? It's possible that we start dumping all the way towards down here for us to get the move up, back up there. No, that's not the purpose of SS levels. But what I am gonna say here is that when you start learning how to utilize them within structure and within narrative, that we tap into the 50% of this overall zone and we start heading higher, but we have SS levels and what did Dave say in video 1, a low that price taps back into before we start heading higher. So again, just examples of this all the time. So SS levels can be used with narrative or as narrative, depending on the context that they're given. And the moment that we get a market structure shift here, let's let's say you actually do want to start looking for SS levels on the downside to take us lower. Why? Imbalance, part of the move origin, market structure shift. The area it comes from is the deciding factor. Remember that. So yeah. Okay. 1 hour 23 minutes and 50 seconds. Dave talks about the three swing pattern. Price fails on the third swing, liquidates the second, and expands from the first. I'll show you guys. So that pattern being that you have this swing point, this same swing point, and a third swing point that could potentially form. Essentially, the concept is just that if price comes up here and fails to put in a new high, you're looking for this first swing point. And this could form in a variety of different ways. I'm not going to go over this, but he goes over the three swing pattern in his mentorship, so I don't want to go over it too extensively. So in that pattern, the area responsible for mitigating the demand zone becomes the new demand zone. I'm sorry, it had nothing to do with the three swing pattern. And if you notice here, he's just drawing out that this area, right? This area that's responsible for mitigating this area, this fractal, becomes the new demand zone. And this is what I tried to explain to you guys earlier on in the video in regards to the example that I used from Friday's price action, where we had the area that was mitigating it. I'm gonna just show. Look, this area that's being mitigated by this area, even hell, even this area inside of it, this area, because we didn't get. Oh wait, no, there's no bodies. Okay, yeah, no. So these aren't areas yet. I just realized that there's no bodies. Where are the bodies? We could just use this area as an example, where this area, right, is being completely mitigated by this area. On a lower time frame, these are bodies. So what I said before is still valid because these are lower time frame zones. But what's it called? This area is being completely mitigated by this area. So for trades, you want to use this area as 50% as the 50% for the entire area. And we look, it delivers one to one, delivers to the high. You see? So yeah. But I do want to say, even if this area is being consistently mitigated right now, once it does leave with bodies, this is still the area that's left behind after it's mitigated. This one. So the point still stands. Point still stands. 1 minute 28 seconds, 1 hour and 28 minutes and 50 seconds. Dave mentions the liquidity grab candle, a candle with a manipulated wick that trades above a certain high after trading below a particular low and closing back in the range. In this example, he's basically just talking about the candlestick structure flip that we like to see, but he's trying to talk about this kind of wick swing. He doesn't do that anymore. 1 hour, 32 minutes, and 35 seconds. There can be multiple different areas responsible for different structural breaks. This is why with every swing we have to break up price as it comes back to tap into it and leave, because we're coming back to the areas responsible for these different type of structures being broken. And that's why we have candlestick structure out to intermediary structure out to overall slash major structure out to institutional structure, as it all vibrates outside itself. So for example, Dave is talking about how this fractal, coincidentally, when he's on the 1 hour, after we just went over that whole fiasco with the fractal, and it's a very similar example, so I'm going to show that one again one more time after this one, is responsible for this major structural break, right? Or up here, this structural break. Then you have up here, this area being responsible for this structural break. Now, price just ends up trading through that. But what do we see in our example? Again, this area became the SNDR responsible for this structural break. Then out here, what do we have? This area that's responsible for this structural break. Now, the one thing Dave doesn't talk about in this example or his example is that he usually looks for a sweep into his area. So you're expecting the absorption of this SNDR for this structural break. Oh no, I'm sorry. It's not that one. He would actually say that it's this one. Yeah, it's this one. So yeah, we break above and we tap back into it. Easy. Now, what ends up happening here? Well, again, it gets kind of complicated, so I'm not even gonna go into that. But you know what? Fuck it. I might as well mention it because this is for me. It's not for nobody else. This area is a area responsible to the left, which is left by this area, or liquidated by this area down here. So what happens? We end up taking this area out, and I'm not gonna say fake news. So yeah, we take this SNDR responsible to the left, we liquidate it, come back down into the area, leave because this was sent price higher before. We come back to it a second time, we leave again. This area becomes multiple mitigated, but it's also the zone at the top of the range for this lower time frame area. And on top of that, this zone at the top of the range for this lower time frame area within this higher time frame structure is overlapping a multiple mitigated area. I'm not going to talk about it that much, but I'm just explaining it for myself with this area, which is the SNDR for this higher time frame structure. So then what happens then is that we take this area, we tap into the imbalance underneath without ever tapping into the SNDR. And I mentioned this not being an SNDR, right? Because it's a fractal from the higher time frame. So technically this is the SNDR. But price, as Dave just said, price vibrates itself through the multiple different structures from the higher and the lower time frame. From the lower time frame, it's a fractal and it doesn't hold. So if it truly was the SNDR, then it would have been designed to sort of send price higher. And a part of me doesn't want to admit that because look at the rejection that it got out of there. But truthfully, if we're looking at this from the time frames perspective, right? Not just from this lower time frames perspective, but from the time frame of the area that it's within its parent structure's perspective, then what we understand is that it's gonna be meant to get liquidated. And this is what I tend to see with MM fractals that turn out to be SNDRs is that they do tend to get liquidated very often, even if they give us a reaction. Oh wow, wait, are you serious right now? All right, I'm not even gonna look at that. So what ends up then happening is that we want to come back into this SNDR here, the real SNDR for this move up, but we can't, and we end up filling the imbalance, right? Consider the imbalance on top of your SNDRs, and we end up moving all the way back up for the real move. We come back to it later, but it's literally no use. Oh shit. It's no use. This zone is already cooked. We don't even give one to one. So yeah. 1 hour 33 minutes and 40 seconds. If you're day trading, use the M15 swings. 1 hour 37 minutes. Dave shows a candlestick structure swing. This is the example mentioned. Um, he marked out this candlestick structure swing and used the larger swing as a guide, similar to how he takes his entries now. 1 hour 38 minutes and 20 seconds. Dave speaks on utilizing an imbalance located at the 50% of a swing that gave him a quick scalp, then a long. He's talking about this swing in particular, right? Um, so here was the imbalance tab 50%, quick scalp, then long from over here. Again, I said, how do we know we're not going back down into these areas? Failed 2. Failed 2. This 2 failed to put in a new low. We come back up. Successful 2. SS proves we're bearish. We sweep this SS level. There's no SS levels on the downside. So this bearish SS could technically be short term because we had a bullish flip, and this becomes a structural flip. This becomes an this becomes a bullish flip, a bullish structural flip like Dave talks about, and we continue to the upside. So I love using SS levels to just navigate the order flow when we're outside of typical structure or when we're unsure of where structure is taking us. Because what happens up here? Look, we get a 2 should have been formed here, similar to what happened here on a lower time frame. On a lower time frame here is what I could tell from the wick of this candle. Failed 2 or a successful 2 on the ISS. Once the ISS's stop delivering, what do we see? You see it come back down into the area. Bro. Alright, from the seconds time frame, what do you see? You see it fail on the seconds time frame. There's still a possibility that it could make a higher time frame too, right? Like for example with this low. This low right here. This low would actually be considered a higher time frame too though. So what happens? We fail to create that higher time frame too. And it's still possible even with this low taken that we take this low when we put in a higher time frame too. But what happens? we fail again. And more than that, we create a 2 in the opposing direction. And within that, we create an ISS level here. So then what happens? You could take this short. You could literally take this short down to the levels here. And then what? Uh, Now that you've seen that we swept this SS level, this is an ugly SS level because of Asia's open. Uh, Now that you've seen that we sweep that here, and then because of this wick low here, we come up, we trade below here. Now that you see that happen, what do you wait for, right? Well, if you're expecting this level to get swept and then immediately head back to the downside, you'll be wrong. Price has to flip before we're solidified as coming back up to the upside. But what does it do? It mitigates this entire area's 50%. This entire area is 50%. It mitigates it. So this is what he talks about where you want to use structure as a directional bias. He didn't mention this entire area is 50%. He was talking about this low here. I think he called this low the S&D responsible. And that's I think, and I don't feel like going back to verify that, so take that at face value. But I'm pretty sure he called this as the S&D responsible. So then what happens? It misses his entry, but if he would have just used this original swing like he was planning on using for directional bias, then he could have put his stop behind his own and do all that, this and the third. But what do we have here? We have SS level verification, long. What happens? SS level created. I believe this is an SS level. SS level verified us that we want to go bearish over here after we swept this opposing SS level. Yeah, because we put in this low, we failed off of the ones low here. We go back down, we take the 2 to the last SS level, and then we go back up. So my trades are always going to be within these twos, this 2, from this low to this high, from this low to this high. And then what am I doing? Once I see that it fails, I'm taking the next 2 to the next SS level. All while understanding what we're doing on the lower time frames. So after I take this short down here, what I'm doing next is I'm taking the long from over here because I know the overall structural bias, expecting those retracements back into the areas. And when price doesn't give me those retracements, I'll find a way to get in, but I need to back test that. 1 hour, 39 minutes, and 10 seconds. Dave discerns the larger structural down move from the smaller S&DR down move that caused the move up or that happened before breaking above. Wait, let me see, because I said I wouldn't verify that, but he literally goes over it. This is the example he's talking about. It had nothing to do with this right here. But given what he said about this down move being the real down move, um, you know, given what he said about that, I'd say that it's safe to assume, because I'm not sure if that actually took the high. I mean, I could check. I'm gonna just play this clip for you guys, or for myself. Talking about you guys, I'm recording this on YouTube, but it's really for myself. I don't want nobody watching this.
Trade higher, but there was an imbalance. Let me actually make this visible for you guys. There was an imbalance directly above the area, this area here. This was the last down move that sent price up.
He said that was the last down move that sent price up, aka the S&D responsible. So he wouldn't count this as the S&D responsible. Now, mind you, in other examples,
Have this area marked out, and there's so many what ifs about price tapping into these areas. So what we mentioned was that this is, yes, a smaller swing point, but also a demand zone that's responsible for breaking structure to the top side, breaking this structure.
the reason I showed you guys that clip is because if we go back to what I just showed you over here, he's saying that yes, this is a smaller demand zone in the previous clip, but the demand zone responsible for breaking a structure. But in this clip, he completely disregards this smaller move as the demand zone for breaking a structure, and he says that this is the last down move before price goes higher. So, unless I'm misinterpreting him, he contradicted himself again there. But there's a key distinction. Because what did I just show you guys about the fractal responsibles? What did I just show you guys? I showed you that from the higher time frame that they tend to give reactions. And that was exactly what he was showing on the 15-minute on crude oil just now. So again, that's something to think about where on the 1 minute, and again, this depends on the context too, because what happened? What happened? Bruh. This one was respected. It was respected. It depends on the context, guys. Because overall, this area and this area is part, I believe it's part of a different time frame. Let me see something real quick. I'm sorry, key distinction here. He's not considering that the SNDR in this example. He's saying that that's the last down move before price traded up. In other words, it's the move origin. It's not the S&D responsible. It's not. He would consider from the 1 minute this as the S&D responsible. But what happens? Price completely liquidates it. It gives a move off of it, but it liquidates it ultimately. So to keep it consistent across everything, I'm pretty sure he's considering this as the S&D responsible, and then he's considering this as the last down move or the move origin. 1 hour and 39 minutes and 5 seconds. What to backtest? The large swing points, and the small swing points within the large ones. 1 hour and 39 minutes and 50 seconds. So you're using the larger swings for direction while using possible areas to spot the reversals. And now you use the inside of that area to lower your risk. 1 hour and 41 minutes and 45 seconds. You don't need the left side to trade. You only need the right if it's trending. 1 hour 42 minutes and 36 seconds. Utilizing swing points on days we have nice rocking pullbacks will give good profits. 1 hour 47 minutes. Candlestick structure is the fastest way to get into your entry and will get you in as early as possible. 1 hour 49 minutes and 48 seconds. Dave shows a 1 minute swing point. 1 hour 49 minutes and 30 seconds. Dave talks about price giving a double bottom after coming back to tap the SNDR to the left, and other ways to build narrative with the trend. 1 hour 50 minutes and 55 seconds. Structure is important because if you know structure, it will give you an idea of which swing points you're using and why. 1 hour and 55 minutes. Equal highs get ran later. I'm not going to sit here and say this is an assess level because it's not. We use the 15-second POIs as targets, not the ones that are actually ran, and then continue lower. But that coincides with Jay's logic as well, because that logic being said, once we ran this, well, let me check if we actually did run it. Hold up. So we didn't exactly take them, not to the tick. But what I will say about this is that I know Jay says that we don't count that we use the 15-second POIs. He says that in video 2. Hold on. So look.
And I'm trading through it with the 15-second, right? But for me, right?
Oh wait. I'm sorry. Hold up. Hold up. What?
It did it, right? If it has been able to do that very thing, this low and this low only on the 15-second time frame, is now the shit show level. This is officially an area for price to return back into. And I
And if we look on his chart when he says that, right? The issue, right, with saying the 15-second only is that on his chart he has a 15-second SS marked out. But then he marks out a 1-minute SS. Similar to what Dave talks about in this example. This is a 1-minute SS, right? If I go back to the FX replay, we see that this candle 31.94.50, 31.94.50, yeah, this runs it. It runs the 15-second SS and immediately goes in the other direction. So Dave is saying that these equal highs also do get ran. And, maybe looking at this now, maybe we should consider these 1-minute POIs as potential targets, as potential SS level targets, not just these ones. Or these ones. Not just the 15-second, but the 1-minute ones as well. Just something to clarify with. And I do want to say before I continue that it's not always that the 1-minute SS's give the strongest reactions, if I'm being honest. That's what I've seen in my back testing. But when they're in the immediate vicinity, like what Jay is talking about and what Dave was talking about, it seems to be the case that we still gravitate towards them before continuing in whichever direction price wants to continue in.